Turner I showed you before. Zoom in big time into the book. This is a fairly decent guide on short-term trading. This is a nice beginner's guide to short-term trading by Tony Turner. So zoom in an awful lot. And essentially is a fairly good book, and I should probably pass them around, right? So they can actually take a look at them. So go ahead and pick this one up. Now the next book to look at is Jack Schwager, Getting Started in Technical Analysis. I have already shown you this book before. It's an excellent book. I've learned an awful lot from it. I've learned the basics from it. He has another big book which I'd recommend, Technical Analysis. I think it's called The Futures Markets. And then he has another big, thick, expensive book of Fundamental Analysis of Futures Markets. So this is a short, concise, easy introductory version to getting started in technical analysis. Next one is Stock Cycles by Michael Alexander. Let's see how I'm going to keep it because it's kind of, it's falling apart. Michael Alexander. Does it read Michael Alexander at the bottom? Does it show up at the bottom? Michael Alexander. Stock cycle. So why stocks won't beat money markets over the next 20 years? Well, stock cycles, it is effectively about cyclical analysis. I kind of forgot, but not quite. I'll give you a little lecture, or one big lecture on stock cycles, possibly combined with commodity cycles on that part. Now, the one book that I'll probably recommend the most for everybody that you guys should read is, well, let's just pull this up. Let's, you know, guys can get the book, and you guys can show here. It's called Wall Street, A History by Charles R. Geist. Now, this is by far one of the best readings that I have read. The other one that is kind of like amazing is that this guy constantly moves back and forth between macroeconomics and stock returns. Essentially, this is where I've learned, well, sadly, or good for good or bad, macro history or U.S. economic history. I've learned well from this book. Well, I've learned also from other history books. But this book gives you constantly that connection as to how the macroeconomy is performing and how the stock market is performing. So it is one of the better books. Of course, as far as I'm concerned, this is the book if you're going to be having a finance in investments course. Of course, for stocks, and mostly stocks, because modern investment courses would also include bonds, and I don't in this course, and they should also include derivatives, and at least I don't cover them in this course. So when it comes mostly to stocks, or what we call equity markets, this is the book to read, and you're going to learn way more than our investments book that we use. Again, when it comes to the stock market, you learn this, you're going to know more about the stock market than a typical MBA with a couple of courses in finance and investments, because that there is mostly theory and too abstract. Any questions so far? Oh, this one is also translated and available in Bulgarian. They're cheap, like 10 euros, something like that. So, Charles Geist is a professor of finance in the School of Business, Manhattan College, and author of 2 other books. Now, the book that I will highly recommend to anyone is this one. Let's zoom in big, called by John, well, let's just put it like this. John Kenneth Galbraith, or sometimes pronounced Galbraith, A Short History of Financial Euphoria. Basically, financial euphoria refers to bubbles. Now, others prefer to call it manias. Sometimes they call it manias, panics, and crashes. And any student, if you're going to be any time in the markets and in the finance field, you have to read Charles Kindleberger's Manias, Panics, and Crashes, a history of whatever. So, this one is by far the easiest. It is by far the cheapest, US $13, actually for 110 pages, for a 110-page book. It is, I would say, fairly expensive, $13. But it's going to give you a little bit of this. Well, let's try and zoom in here further on the contents. You see speculative episode. Then you see common denominators. The classic cases, you know, the Tulip Mania, John Law, and the Bank Royale. Number 4, classic cases, the bubble. Number 5, the American tradition. Number 6, 1929. Number 7, the October Redux. And basically, it's going to give you a little bit, 10 pages of each, a short account, but you are going to be on your way, well, you are already on your way, because you're already in this course, into understanding bubbles and this type of stuff. Now, what is his thesis? And his thesis, it's kind of important to summarize it. When he says, a short history of financial euphoria, so let's write out here Euphoria, which is more or less appears to be equivalent to bubbles. He essentially, his thesis, which kind of works through well from the beginning till the end, is that you have two components which, when mixed together, produce a euphoria or bubble. Well, let's just have bubble, and here let's kind of use the other word, mania. And this was also my first book, which I read many years ago, which kind of has convinced me, as I have read 6 or 7 other books on the subject, to his formula to be fundamentally sound and correct. Number 1 is credit. No credit, no euphoria. No credit, no bubble. Again, no credit, no mania. You cannot ever possibly get a bubble or mania unless you have massive credit expansion. And number 2 is speculation. You need speculation by the masses. You need people talking about it. You need these guys coming to you here and telling you about the greatness of our financial market, even though right now it might be in correction. All right. So this is what it is. Now, when it says credit, you should simply associate it with, as we call it properly in finance, we call it, all right, let me guys push this, through you so I can actually take a look. So, credit is the same thing as leverage. Okay, so ultimately, bubbles are made of leveraged speculation on a massive scale. Again, if just 5 people do their little speculation, no good. You gotta need to see a whole lot of people, and you gotta see it in the psychology. I'll talk a little bit more about the real estate bubble in Bulgaria again in a minute, about this psychology. So speculation and leverage. Is this good enough for now? Is it clear? Alright, now one of the best books, at least that I have seen, which I have by far read, and it is a fairly recent book. It's called Devil Take the Hindmost. It has gotten already a fairly good status, a cult status amongst those that know and understand, by Edward Chancellor, and it is subtitled A History of Financial Speculation. A History of Financial Speculation. So, it has fairly, it's like 400 pages. It has a fairly extensive treatment of a whole bunch of bubbles. So, this bubble world, the origins of financial speculation. Of course, financial is not enough. It has got to be leveraged, all right? So, here has been constantly a recurring theme that, yes, it was a speculation, but when the leverage entered the pictures, things got ugly down the road. Of course, in the early phase, they are sweet and beautiful. So, stock jobbing in Change Alley. What is Change Alley? Guys know Change Alley? Well, that's London. These are some of the earliest stock exchanges are in Change Alley. And he's talking about the 1690s. Well, first of all, he's talking about the first speculations and manias occurring in Roman times. In Roman times, people had these deals which involved deals that you make today for a future delivery of grain and of other stuff. And then, if you're going to be making that delivery, then you make this deal, it will be secured with a down payment. Well, what is this? I'll call this. Well, it's called a futures contract. So, you're told, at least, modern guys, professors are telling you that futures derivatives market kind of like took off in the 70s, like derivatives just were invented in the 60s and 70s, right? Well, this is a big fat lie. I mean, derivatives existed for 2,000 years. Well, if you want to buy some wheat because of some problem, I mean, we're talking about Roman Empire, Caesars, Augustus, etc. during those times. The other thing that you'd see is that people just wanted to secure the supply at a decent price. They didn't want to run the risk of, the price of wheat running high for whatever reason. So what they would do is pay a little bit of a premium and secure the right to purchase it at whatever price. Well, this is a classic modern option, all right? So the point is, again, that we're told that leverage and especially derivatives are invention of the modern mind. Nothing could be further from the truth. Now, one of the bigger other experiences is tulipomania. This is, the tulip mania that happened, whatever, and all this kind of stuff. Well, what is one of the characteristic features? There is something astonishingly simple. People started contracting on these tulip bulbs well before they would come along. So, if the bulb is coming, now how about for a penalty for the two of you? You just earned it, don't worry, if you want you can double it, alright? So, they were contracting early in the fall, September or October, for the bulbs that will come in the spring. And if they would contract for that, and they'll fix the price and all the stuff, and they will pay a little bit of a premium, what do you get? You get a classic futures contract with a fairly decent amount of leverage. Again, you'll realize that futures and options are nothing new, and that leverage and built-in leverage within futures and options was, dating way back centuries and millennia ago. So what he's talking about is now South Sea bubble, then there's the East India stuff, then he's talking about the railway mania, then there is the canal mania, then there is, before there was the speculation of the Gilded Age, a great chapter on the speculation leading to the crash of 1929. Then he's talking about the from Bretton Woods to Michael Milken. In other words, this whole crazy mania and bubble associated with these Michael Milken bonds. How called? Junk bonds, where people believe junk to be gold, just like they believe now that subprime is gold. Of course it wasn't, right? Turned out that subprime was just a fancy version of junk. Well, they were just junk mortgage bonds, all right? So, again, he's explaining, and then you have the kamikaze capitalism. This is about a great detail of the Japanese bubble economy of the 1980s. What is important is that, and interesting and highly educational, is that rather than focus on the bust, which of course he describes, he actually focuses on the boom, as the boom is what makes and creates the bust. So you have to understand the boom, and this is by far one of the best books out there that anybody should at some point read. Of course, not Bodie Kane, the textbook that we have. I mean, it's not worth much. I mean, you read this one, you get to understand what is going on, and you can see the real estate bubble. Finally, one of the best books which I have read, let's say the best book that I have read for the 21st century, meaning since 2000, which is written after that period, is Marc Faber. Marc Faber is legendary in the investment world. His views are well regarded. He's had difficulties when he was a young trader. He's learned a lot, and now he has become to be the most accomplished investor in the world. He's also the most reputable. He has made some phenomenal calls right before the collapses. He made the call on the 1987 stock market crash. A few months before that, he was able to pull out all of his clients not to sustain losses, and those that were courageous enough to actually short the market and make money on the way down. He's predicted quite correctly the Asian crisis. Of course, during the boom period, when you're saying, hey, you know, Singapore, Hong Kong, Thailand, and whatever, Malaysia will collapse, during the peak of the boom, you know, they tell the old man has lost it. Well, no, quite the contrary. You know, I got my doctorate from what I call Marc Faber University, meaning I have been a student of Marc Faber, have studied most of his writings, have read him. He is probably one of the best analysts today in the world, especially when it comes to global issues. I've mentioned before, Peter Schiff is another one of the top guys in the world, but anybody at any point in time should order Tomorrow's Gold, Asia's Age of Discovery, and you know, have some Marc Faber. What I'll probably do is some edutainment. We can play some Marc Faber and some of his views on the market. So, now let's talk a little bit about the real estate bubble in Bulgaria is reaching the ultimate manic proportions. Well, how do I know? Well, my dad, as I've been telling you before, is 71 with, you know, as difficulties now we're seeing. So he's mostly watching TV. They just said recently, like 3 days ago, that prices, real estate prices in Pleven went big time up, and that I have to go buy now, buy today, a second apartment and invest in apartment because prices will keep going higher and higher and higher. And if I don't buy now, I will never ever be able to afford and buy a second one again. And if I buy now, I will secure my retirement in the future. And then gets the story that real estate prices never go down, and they just confirmed it on TV. So on TV, they kind of like reminded people that they gotta get in now because the prices will run away from them. Well, I reminded them and said, well, wait a minute. Black Sea prices went like 10–15% down. The answer is, it doesn't matter. It doesn't matter. This is irrelevant. I said, well, but in some of our ski resorts, prices are already fallen 20%. We got this nice, beautiful place, Aprilce. Prices are down like 30%. So no, it doesn't matter. It's completely different. It's a vacation resort. It is not applied. You know, in Sofia, prices will never, ever ever possibly fall. So, you know, any single argument, say, hey, the U.S. price is already collapsed. I mean, it's kind of like a catastrophic situation. No, 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 that's America. Certainly doesn't apply. Prices here are now dirt cheap, and they can only go up, up, and up. Well, this is the typical mentality of every single bubble. Now, another example of a bubble is our Bulgarian stock market, right? I've discussed before, Bulgarian stock market is a wild bubble. Well, what told me the first time we had a bubble? Well, one of my best financial advisors, of course, is my dad, right? He's never had a single course in economics. I mean, nothing matters. He's an engineer. He's a great engineer. You know, he was teaching others engineering stuff. Well, he told me that, son, we should probably, that's 2005. Son, we should probably get in the stock market. You know about stock markets, right? And I said, sure, right? Yeah, of course I teach stock markets. Well, we should probably get in the stock market because I hear a lot of people are making money in the stock market. I said, sure, yeah, a lot of people making it. Well, but they're making big money and we're losing big by not being in the stock market. Well, someone asking, well, where do you hear these things? He said, well, retirees, you know, we're talking in front of the block, you know, how they get together, 5 or 10 of them, they got nothing, they're 65, 70-year-old guys, and they're talking about trying to get in the market because people are making tons of money. So I said, wow, this has got to be the big bubble blowing up. Of course, it was back then. Of course, it blew all the way to 2007. Now, at least we suspect, or at least my working hypothesis, that has ultimately burst. But in 2005, you know, you got retirees who get a 200 level, let's say, retirement pension. That's 100 euro a month. And they are willing to, you know, save half and put it in the stock market. They don't know anything about the stock market, of course, and all the games and everything else, but people are making money, so they should get in there.
Which year was that?
That was 2005. I came back in Bulgaria in 2004. I was already working. I was already around. And, you know, already was present a wild real estate bubble. Well, the real estate bubble was more than apparent in 2004. When I was in the US, I knew there was a wild real estate bubble. Why? Everyone was borrowing against, Bulgarians are borrowing against their American property and buying, you know, properties on our Black Sea. Why? Real estate prices are going up, up, and up, and Europeans are going to be buying them at sky-high prices. 2004, the thinking goes that we're going to enter the European Union in 2007. So, when the Europeans come, now they're going to buy dirt cheap, and the dumb, stupid Europeans are going to come in 2007, because we're in the European Union, and they're going to buy it extremely expensive. And our Bulgarians will be filthy rich, you know, at the expense of dumb Europeans. Well, dumb Europeans are not as dumb. What do? Well, they organized their investment fund in 2004 and 2005, and they invest indirectly. We might not be in the European Union, but it is the Europeans who, in the expectation of getting in Europe, were already buying. So when I wrote in 2004 or 5 that Europeans are already loaded and they are also fueling, well, the Europeans, who are we talking about? We're talking about major financial institutions. Many of them are in the category of smart money. So the smart money was buying back then, and in 2005, 6, and 7, who's buying? Well, for now, no offense to anyone if you bought property recently, who's buying mostly the dumb money, all right? I mean, 2004, the bubble is more than obvious. And in 2006 and 7, it is, especially 2006, Bulgarians buying in anticipation of entering Europe. Well, Europeans, of course, started buying the next day that we have our, accession agreement of fund. I mean, you have your accession agreement in 2003, they are buying the next morning. I mean, the next morning, it's a great line. Go ahead and buy. Well, that's what drove real estate. The first spurt bubble was it. But that's not how people understand it now. But now, if I don't buy now, meaning today or tomorrow, I'll never, ever afford to do that again. Even though it may be a top 3 or top 5 income earner, doesn't matter. Well, I'm asking, well, how will, ordinary kids going to buy when they graduate out of high school and they have their average incomes? And the answer is, they'll never, ever going to be able to buy, just like you will never. Well, if they can't buy and I can't buy, well, who's going to be buying those houses? See, I mean, there's an illogical or inconsistency in the arguments. Now, another example, best example is provided by, I was listening many years ago, Marc Faber provided the story of his wife going to him, asking him for, a couple of thousand to day trade. His reaction is, what do you mean? She says, well, we're at the hairdresser and my girlfriends are talking about, buying stocks and buying them in the morning and selling them in the afternoon. The guy says, I am in almost 40 years in the investment business and I manage tens of millions of dollars. We're married for over 20 years. My wife has never had the slightest interest ever in what I do, in any investments or anything like that, but suddenly my wife is interested in buying stock, day trading, speculating, buy it in the morning, sell it in the afternoon, and make money just like her girlfriends. He says, I get scared, big time, and my wife says, well, could you give me $5,000 to trade? What's the answer? Sure, honey, here's $5,000. But there's a deal. Just tell me what you're buying. And she says, oh, no problem. I'm going to be buying tomorrow morning, whatever. And so what's he doing? He says, I'm getting even more scared. This is my largest position in my fund. So, next day what happens? Next day, his wife buys early in the morning and the stock just collapses. Well, how can the stock collapse? Well, the answer is he sells a couple million shares from his fund in the morning until by lunchtime he liquidates his all positions. He bought a long time ago. He's posting some phenomenal gains. He'd better get out. Why the getting out is good. Well, what happens in the afternoon? The stock falls a whole lot more because he shorts a couple of million, right? I mean, if it's gotten to the point where his wife is eager, so, his wife doesn't get back for a while, late in the evening, hey, honey, what happened today? Well, unfortunately, I lost it all today. And she says, well, so what do you want to do? And she says, well, can I go for another $5,000, so I can speculate again tomorrow? Maybe I'll have better luck. And he says, sure, you're going to have better luck, and I promise you, but if you want to make some money tomorrow, you'd buy at 12 o'clock, all right? So, and the deal stands. You got to tell me what you're buying. And she says, well, for tomorrow, I'm going to be buying this. He says, okay, you're going to make money tomorrow. Here's the $5,000. So, he liquidates all morning long, his second largest position. And, price falls, and at lunchtime, she buys it. At least she doesn't lose money, but he gets out of it. So, his point was, the best financial advice and the most timeliest I have ever got in my professional career was from his wife at that point. All right? So now you got to understand, just like Marc Faber, his wife telling him she's eager to get into speculation. So my dad talking that, retirees, 70-year-old guys have a couple of hundred left, want to, buy some stocks because it's good to buy, that there is a bubble. Now, another legendary investor in the world is Peter Lynch. Guys, Peter Lynch, have you heard of him? nothing to do with Merrill Lynch. Peter Lynch, just a guy. He is managing a huge funds. And he says, the best investment advice I have gotten is from my wife. Says she knows nothing about investments, but she is one of the best shoppers I know. Well, of course. So he says, I always follow my wife's advice when it comes to investing. This is called a special approach in investment. It is called the consumer approach. He says, when I don't have any good ideas what to invest and what to put the money, what do? I get my wife and I get a couple of grand in my wallet and we say, we go shopping and we're buying whatever you convince me is good to buy. So they walk in and she shows some nice quality, Brian, all the good stuff. She wants to have it. Well, but why do we have to have it, you know? So she says, well, it's got this new material and all this kind of stuff and all this kind of whatnot. Okay, so he buys the stuff for her and then goes and checks the stock. So what next? She says, well, this is a brand new shampoo and all the great stuff and whatnot, and this hair dryer is, you know, much better and all this kind of stuff. So what do? He says, I buy one for her and I buy a dozen for all my, you know, colleagues in the office to, you know, give as gifts to their wives. Then she's talking about an iron. This iron's got this super special feature, like, you know, all of this stuff and that stuff and everything else. So this, you know, iron is a whole lot better. So it says, well, is it really better? I just buy 10, you know, give each guy in the office. He, you know, makes a gift to his wife and see what the reaction is. If he gets a couple of calls within the next 3 or 4 days from someone's wife and say, hey, Peter, thank you. This was a great iron and I love it and works great and all the good stuff. Well, this is a great, good product, all right? So the idea is that, you know, if there is a really good product, if the product sells really well, we should look at the company and see if the company is profitable, if it's doing well, if the product will turn it around. You know, so then comes, for example, the next thing, well, we want to go on a restaurant, but on that restaurant. What's the test? He says, okay, I'm going to buy the restaurant and, you know, get all the guys in the office. They'll have a nice party and all this good stuff. And then he tests the next day. Hey, honey, do you want to go back again to the same restaurant? What's the answer? If his wife says, yeah, sure, it was a great restaurant, you buy the stock of that restaurant. It's a restaurant chain, right? If his wife says, no, not really, well, the service wasn't great and all this kind of stuff, then, well, no way, you know. So that is the type of investing. You see, you understand that type of strategy, what I'm talking about? So they all go to, let's say, to some conference. They all fly with the airline. The airline loses their luggage. They're 20 minutes late and all this and that stuff. And suddenly the call is, well, this airline sucks. We just dump it. We just use some other airline. Well, if that's the case, you begin looking at the airline and say, hey, it might be a good candidate to short it. So the example he gives is these cruises. What was that, you know, what was that cruise that you get on the ship, and then the ship, you float for 3 days up to some nice destination. You stay there for 2 or 3 days on that destination, and then you get the ship back, and it's kind of like a sea or ocean cruise. You understand what I'm talking about? Well, his wife is eager to go on one of those, right? And it's called Carnival. So he says, well, why not? Let's go and check it out. So she's asking, why do we have to go there? Can't we go? And she starts saying, no, it's great. I mean, first of all, you're for 8 days. Second, there are like 300 of us. With, 8 days, we're going to make a lot of friends. Second, you have a lot of parties every night. Third, you go to a nice exotic destination, Hawaii or whatever, Belize, I don't know, some exotic country. Then, you have all the drinks and whatnot, all the meals are free and everything else and everything else. And he's asking, well, how are they making money then? Well, she says, I don't know and I don't care. They charge $400 for 8 days. I love it. And that's the end of it. I just want to pay 400, you know, for him to pay 400 and want to have the cruise. And she says, if they're not making money, they should probably just charge 500. Again, she doesn't care. She's just a consumer. So he says, hey, I just walked and, you know, tried it. We went for 8 days. I got also a couple of guys from the office. You know, let's check it out as consumers. Everybody loved it. Everybody thought that next year we should go again on Carnival Cruise. And the answer was simple. Let's check out their financials and get some stock. And says, well, that was, at least back then when he invested early on, was a great stock. So, other ways to invest. Again, this has nothing to do with, standard investment. Garver says, my kids, well, at least back then, because he was a young guy, my kids are desperate. They gotta get this game. Well, kids, why do you have to get this game? I mean, there's no reason to get this game. Well, what's the kids saying? Well, everybody dad's got it in class. I mean, we're like 30 kids and 29 of them already got it. We're the last ones who didn't get it. Well, so what's so cool about the kids? Well, about the game or whatever? The kids don't care. They have to have the game. This is what they want for Christmas. Well, if they start negative for a second day or for a third day, what's the conclusion? Well, that product's got to be the winner. Let's check out and see who manufactures it, what else it manufactures, was it recently at a loss, was it possibly undervalued, is it very likely that because of this, I don't know, Nintendo thing, suddenly, or Game Box, suddenly they will make a big profit and suddenly they'll make a lot of money, and from the red they can turn into the black and the stock would skyrocket. So, this is, let me wipe this off. Well, I don't have it. So, called Peter Lynch. And it is called One Up on Wall Street. It basically explains this approach to investments. You just look around and see who does what sells, what doesn't sell. Another thing, when he was talking about the restaurant, hey honey, can we go back on Monday night? If she doesn't like it, well, of course he doesn't buy anything. But if he goes back on Monday, he's looking, are there a lot of customers? Are customers happy? Are they satisfied? If there were like 50 customers on Sunday night and only 4, or there are only 2 with his wife on Monday night and it's empty, maybe it is not as profitable as it looks like. Alright? Does it make sense? Now, based on this type of analysis, Jim Poplava has developed, of course it's phenomenally primitive, but the idea is that's not it's primitive, it is extremely simple, yet works absolutely perfectly as his, what indicator, macroeconomic, how is it called? Anybody? The parking lot indicator. Parking lot indicator is simply, you got a nice huge mall, movie theater, 3 or 4 large chains. You guys have been in the US and seen. And then you have a huge parking lot, right? Usually, especially in Southern California, parking lots are always not quite sufficient. If you can easily find spot, then business isn't going really well. Meaning the movie theater is probably not full, the Walmart is not full, the Kmart is not full. You got like 15 or 25 or maybe even 50 businesses working inside the mall and with the movie theater, and apparently if you can find a spot, not a lot of people have come to shop. Now, what is the parking lot indicator? Well, usually the parking is full. So what's the measurement then? The measurement is how long you gotta cruise around the parking until you actually find the spot. Alright? You can find in 2 minutes, apparently not too
difficult. Well, if you gotta cruise around for 10 or 15 minutes and, you know, wait for a spot, and then you finally get to see that spot and someone else, you know, jumps in front, you know, cuts you off, then apparently it is, a lot of people are eager to come, and if they're eager to come and are already trying to find a parking, apparently it is. Well, what is this indicator? This indicator is a classic macroeconomic consumption indicator. So you're saying if movie theaters, if restaurants, if Walmart, Kmart, you know, all of those big chains, if, you know, parking lots are full, apparently consumers aren't having major problems. Also, you walk in and you just sit at the door and watch. Are people just leaving empty or leaving with the bags? All right, that's another indicator. Another indicator, just sit in front of the exit of the mall. And people, as they're leaving, you just count the percentage of people with some shopping in their hands versus with empty-handed, right? If most of them leave empty-handed, well, they just went to have fun and whatnot, but ultimately they didn't buy anything. So, again, this is the approach, the so-called common sense approach to investing. It usually beats every single time sophisticated econometrics. Of course, sophisticated econometrics is based on the false premise that data are good, and then your model is good. Well, with a parking lot indicator, a nicer way to look at it is you just come at 8 o'clock at night and count the number of cars that are cruising and trying to find a spot. Tonight there are 3 cars, next night there are 50 cars, the next car there are 200 people, and everybody is desperate to get a spot. You see, it is very simple, but you have some nice comparability, and you have a nice clean measurement. Of course, it is primitive, but in reality, it might be reflecting some macroeconomic fundamental realities better than what the government statistics are saying, or especially what Wall Street is saying. Guys, any questions before we move on to some charts? Do we have time? Like 20 minutes. All right. Let's pause for a dollar. See what happened. Try to get it at 700 underneath. Okay. Well, yeah, you could put one here. That's okay. It doesn't matter. Well, first of all, you see, this is kind of like yesterday. So over here, right here was, what, 2 days ago when I told you guys that I have all nice technical indicators suggesting to me that the dollar has meaningfully bottomed. Well, this one is also suggesting that this is a meaningful bottom. Again, this one is also suggesting that this is a meaningful bottom. So it may be a safe bet for now that we're having a short-term or an intermediate bottom. Again, what was the indicator? The indicator was Monday and Tuesday, Wall Street keeps hammering, dollar crisis. And on Wednesday, our faculty is all edgy about dumping the dollar and moving to euro, right? They don't want Swiss franc. They don't understand. It's the story. All right, so let's move on to ex-EU. Let's see what happened with the euro in the meantime. And what you'll see is that the euro actually peaked. Euro right here is when we were having that lecture. So what you see is actually euro falling to 156 and then to 154. In reality, euro didn't fall. It was mostly the dollar having a major correction or a major rally against all currencies. So in this particular case, it's not that the euro has lost a lot, it's that the dollar has regained some. Well, let's try gold. The gold cartel, that will be, you know, bullion banks and central banks, did a phenomenally good job, you know, for the last 2 days to completely hammer gold from good $1,000 to almost 900. So gold lost roughly $100 in roughly 2 days. Why would they want to do that? Well, of course, if they have a thermometer, they want to break it. Plus, they have shorted tons of gold. So they have gold positions. What they want to do is engineer a sell-off. When they engineer a sell-off, well, how do you engineer a sell-off? You're Barclays. Barclays is one of the big engineers. What's Barclays doing? Well, number one, pulls off all bids. Bid means I want to buy at a specific price. So bids vanish, disappear. They don't want to buy anything. And at the same time, they start sell, 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 sell. Of course, this is not real gold. What they're selling is gold futures contracts. When you sell a gold futures contract, it's just a paper promise. You don't have to have anything. I mean, it's like any other paper. You can create futures contracts infinitely. I mean, you can print futures contracts as much as you want. Well, the exchange would require some minimum margin, but that's a whole different story. If they have it, if they post it, legally they post it. But the point is, they suddenly offer 10 or 20 or 50 times more contracts on sale. And when they pull the bids, suddenly, you know, who's going to buy? Well, already funds have been already buying all the way to 1,000. So funds are already fully margined. And ordinary people, you know, those small positions are also fully bought out. So they are all at the margin. When they're at the margin, they cannot buy more when Barclays and JP Morgan or the bullion banks try to sell. They can't buy more because simply they don't have any margin in their account. Banks themselves pull their bids. So on this massive selling, there are no buyers. Well, when you don't have buyers on a massive selling, the price collapses. Well, what's the next step? Well, the price collapses. Suddenly these hedge funds and individuals, what do they get? They get a margin call. The broker calls them and says, you got to post by tomorrow, whatever, thousands or millions, depending on the size of your position, to cover up your losses, or I'll simply liquidate you. Well, many of those small guys have no choice. I mean, if they put in, let's say, 50,000, and now they're running a 50,000 loss, they can't come up with another 50,000 again. So, essentially, they get liquidated. What does it mean liquidated? Their broker gets the contract and sells it. Well, if the broker sells the contract, who's buying it? Well, bullion banks might be buying it, but bullion banks would rather not buy. Again, now, what happens? You got three parties. You got the hedge funds. They are already on the margin. They get margin calls. And when they get margin calls, they don't have any cash available. So, funds get liquidated, so they have forced selling, whether they like it or not. Individuals have forced selling, whether they like it or not. So the next day, they get the forced selling, and the bullion banks are still, the shorts are still not buying. So now, a second time around, say from 940, it falls roughly to 910. This engineers a second round of margin calls and a second round of liquidations, right? So on the next day, you got even more selling than the previous day. Well, now the bullion banks will come and will sweep back all that is sold. Remember, they were short. Remember, they sold even more shorts. So now they're going to buy and cover most of their shorts. I mean, you can see the cont, commitment of traders reports, exactly how much their short positions are and exactly how much they were able to cover on this artificially engineered sell-off. Well, this is a classic example since the beginning of Wall Street of price manipulation, right? So that's what it is. The idea and the objective is to manipulate the price so as not to provide the appropriate market signal. Of course, according to the US law, this is commodity law, and futures securities laws is strictly illegal. But because it's done by the major bullion banks, and of course they are also the major banks in the United States, I mean JP Morgan for example, they're not just going to sue and bankrupt JP Morgan. Usually everybody does nothing about it. Alright, so the manipulation keeps going and going. Let's try silver and see that silver got whacked in the same way. Well, you got to understand, this goes on, has been going on for 6 or 7 years now. And here's a massive sell-off here once, and a massive sell-off here twice. If you actually try, Nick, and possibly pull up a 3-year chart, you'll see that this is not just uncommon. This is a regular, repetitive occurrence over and over again. You see here, this was right here in 2 or 3 days, massive sell-off once. Again, in the 2 or 3 days, massive sell-off again. In 2 or 3 days, massive sell-off. In 2 or 3 days, massive sell-off. Again, another one. And again, another one. Again, all of this is going to tell you that for roughly 3 years, you have 1, 2, 3, 4, 5, 6, 7 in a row, massive engineering. So again, what is the point that I'm making? In technical analysis, you get to see, you get to learn, you get to understand, you get to see where the sell-off ends. It ends off in roughly oversold territory. Here it ends close to oversold. Here, close to oversold. Here, on oversold territory. So, what does it do? Well, there is a really decent chance that it will fall a little bit into the oversold territory. And then the bullion banks will come and sweep to cover as many shorts as possible. Remember, they are shorts. On the way up, they are sustaining massive losses, for which they must constantly post new margin. Now it is their day that at least they can reap some major profits and benefits. Is this, guys, on the manipulation fairly clear how it works? Does it make sense? All right, let's move on to, well, let's get back to 6 months and possibly something else. Let's see the Dow Jones. Dow Jones seemed like it made a very meaningful bottom. Now, remember the thesis that I developed last time. You want to look at intermarket. Gold told me that it's likely peaking. At the same time, the dollar told me that it was likely bottoming. And if these two are simultaneously peaking and bottoming, very likely Dow Jones itself experienced some meaningful bottom over here. Well, from 2 days ago, you see it tested the low, but at least went up, major way down, a major way up, major way up. At least there has been, the Dow Jones has been holding. Again, very extreme volatility. 400 points on the way up, 300 points on the way down, 300 points on the way up. That's, well, you can see 2% volatility, meaning the overall volatility of the stock market has dramatically increased. Well, if it has increased, it's probably speaking of a meaningful, at least possibly, intermediate bottom. Well, this may actually be the peak, and it may fall off, but the more reasonable thesis will be that it recovers a little bit higher before the bear market continues. Again, it's hard to say. Well, let's see what happened with the yen, and let's see what happened with the Nikkei. Right? I mean, you guys gotta get what I'm also trying to do for the last month or so is kind of get you in the mood of following the markets, thinking about them. Well, you see, this was, as I suspected, at least for now, this was a very meaningful exhaustion gap and is a classic reversal. And now you can see back that it's falling and recovering. So again, I don't know, but for me, as far as I'm concerned, this was a major, meaningful top. There will be quite a bit of a correction or consolidation. Very likely back to around the 50-day before a new run-up begins. Well, how long it's going to last? I can suspect anywhere between 3 weeks and 3 months. But as Doug Noland and some other technicians, well, he's not a technician, says, we got to watch it every day or we got to watch it every week and analyze in interrelationship with all the markets before you can say, okay, it corrected to 96, and we can say that at 96 the correction is over. For now, I'd suspect 2, 3, 4 weeks, certainly no long positions in the yen. Here, extremely dangerous for a long position. Now would be probably, what will be the position now? What position, if you gotta get in the market now, what would you do? Well, now the safest bet, which has a high probability of a payoff, is simply buying a put on the yen with a strike of 110, of 100 or 99. You buy a put somewhere over here. Well, are you guys, some of you in the game? Well, if you guys are in the game, go ahead today and buy a put with a strike of 99. You want a highly leveraged put. What provides a high leverage to a put or to a call? Well, two things provide high leverage. First of all, it has to be out of the money, but not a whole lot. So if you're buying a put, you're not going to be buying it with 102, which is low leverage, and you're not going to be buying it with 92, which will, so 98, 97, 99 will provide you the maximum leverage. Now, what else provides a maximum leverage for a put as well as a call? Well, time. You want to have it as close to expiration as possible. That's how you get the maximum risk of losing it all. But if it moves because it's cheap, there are 30 days left, right? Instead of, let's say, 1 year. So there are 30 days left. It is cheap, right? Because it's got a little time to expire. But if it moves in your direction within these 30 days, because it's cheap, it's going to gain a lot, and you can get a huge return. So now is 21st of March. I will get, let's say, April, or at least those that expire in April puts, with a strike if they have 98 or 99 will be excellent. That expire end of April. You got to watch about expiration. When they say an April contract, you got to watch out. Isn't it expiring in 2 days? You see, Nick, we can probably do that. Pull up another one with Man Futures. I think we might actually have it bookmarked. And you got to watch when you click on the contract. It's got to tell you 3 days to expiration, 7 days to expiration, or 292 days to expiration. So, for your game, you should be looking at an expiration ideally anywhere between 20 and 40 days. This will give you the maximum leverage, and at the same, well, try and click, just click on the dollar. Let's click on the dollar and see what happens here. And then let's see what trades. And then when we're going to see, so, oh, we have only June. Well, click on the June and see if it's going to tell us how, how many days and if it expires anytime soon. Then we should be able to find on the currencies a whole bunch. Well, is it saying what's the expiration here? I don't see it in here. Quote options. Do you guys see exactly what the end? Well, that's not the end date. All right, I'm gonna research it for you next, guys, and I'm gonna tell you, what expires when and what might be a Japanese yen that does it right now. But it is.
It says expires.
Oh, there you have it, guys. Thank you. So you see now, for the June contract, it expires June 16. So in your game, if you get let's say an April contract, presumably expiring around April 16. Well, we got to pull up a calendar because they usually expire on Fridays, right? I think they expire 2 or 3 Fridays before. The third Friday. So if this is the third Friday, just look up at the calendar. And for April, the third Friday will be April 18th. So, April 18th, so an April contract expiring April 18th will give you roughly 27 trading days, calendar days. And 27 calendar days will give you a perfect leverage for the situation, all right? Again, with gold, it's already too late to buy puts, and when the gold market gets whacked like that, the forced liquidations do not allow for the gold market to recover rapidly on the way up. So now you can't buy any options on that thing. Do you have options on yen, on currencies? Do you have any futures?
I cannot trade futures anymore.
Well, what about options? Well, you can try an option on the yen ETF. So this is yen futures, right? You have futures and options, but you will also have a yen ETF. So it will trade just like a stock. And if it trades just like a stock, you will probably have an option on that ETF, just like you have an option on Microsoft, all right? So we're going to try to find that. So the GLD is the ETF for gold, but it's too late to enter now. The ETF for silver is SLV. Again, too late to enter that position for the game. So Nick, let's go again and take a look at the Nikkei. And then we have crude oil. And see, the Nikkei finally hit in here, some recovery. I was expecting probably one down day further and then up. But here's the thing. You gotta synchronize your expectations with the Nikkei, which is the stock market, and the Japanese yen. We just looked at the Japanese yen with the exhaustion gap should have given you a good indication that at the same time the Nikkei is likely to be bottoming. So you can try to find for a Nikkei some sort of an ETF and buy an April option for that, and that should also be a fairly decent bet. If you want a 1 month game, you gotta win to make big money. The game is only with fictitious money, so there is no loss when you lose. So you want the maximum leverage and the maximum possible leverage for a maximum swing. You're going to get it out of some nearby, out of the money option. All right? So that's the Nikkei. What else do we have? The TNX or WTIC? Yes, let's try this first. And then you see, this speaks here. Watch this, guys. You have from 110 to 102. This is an $8 super wide ranging day. First of all, apparently it has become intolerable for Wall Street to permit 110. So again, they whacked oil as much as they can. Again, as I was explaining, it's a lot harder to whack oil as it is to whack gold. But see phenomenal strength in the oil market. 2 days ago, again, from 104, 105, went up all the way to 109. So they whack it $6, the next day springs back 5. They whack it again even harsher the next day. Well, now the oil market is comatose, right? Why? Because the same funds that are long gold, they're also long wheat and they're also long oil. Now the same funds are facing phenomenal losses in the gold market and they got a post margin there, so they get liquidated and now these funds are out. They're sustaining phenomenal losses in oil and in gold, so they gotta be liquidating. So usually the better way to really manipulate and collapse the oil market is first to hammer gold. When you hammer gold, they get a wave of margin calls. So they suffer phenomenal losses. They liquidate all of their gold contracts, but because this is not enough for a commodity fund, the commodity fund will have to, whether like or not, sell something liquid. Well, the most liquid commodity in the world, of course, is crude oil. So now they start selling crude oil, and then what? You pull the bids and engineer. So This is the same example of engineering one market collapse feeding on to the next. Well, how do we call this? Contagion. It's contagion. One market falls, margin calls, that affects the second market. Now the crude market collapse, then the ag market collapse, and you start a wave of losses for all of those longs in commodities, and one loss feeds for margin calls, for more selling, for more losses, until you wring out the leverage. In other words, you wring out the leverage and the leverage speculators. Again, those that are on thin margin. Those that are well capitalized, you certainly can't flush them out. I mean, who might be a well capitalized buyer of gold or oil? Who might be really well capitalized? Well, of course, China. Of course, it will not go with Chinese government. They're going to be working through some fund. And if the fund says, well, we're running phenomenal losses, we need 50 billion to post margin, Chinese government says, here's 50 billion, post. No big deal, right? Who else is a big player on the gold market? Well, Russia. Russian government realizes the value of gold. They don't mind buying up a whole bunch of gold, and they do. One last market will be what? The interest rate, and we should be done for today, right? Alright, so let's take a look. Did we miss any major market? Stock market, currency markets, commodity markets, bond markets? So, what we're seeing still is, again, the market is indecisive. It can't penetrate through. This is not a time to fool around with the bond market. Again, if you want to be a cowboy and bet this is going to hold, fine, but you can't bet either way. So this is a time to get out of the bond market and do nothing. Alright? At least that's how I see it at this point. You guys happy? You're done for today? Alright, we're done.